Hello, everybody, and welcome to this week's podcast, published on March 19th. I'm good. I'm joined by good friend and colleague Joseph. How you
Mhm.
doing?
Doing well. I mean, market's been a little all over the place, right? But
Yeah,
a few big changes. But I guess the most important thing is that March Madness starts this week,
I know. Yeah, we were talking
right?
about we were like looking at how many wings we're going to need to get in the office. I think we're doing like, 200 wings or something like that. We're going to run a relative strength competition on who can eat the most amount of wings
Yeah.
within the office, and we'll update you next week. But who you got winning it all? Do you
Uh,
have your major bracket yet?
I don't have a major bracket yet. I mean, I feel like Duke's pretty good this year. I always feel like they make it deep, and it's like if you're gonna put a toss up. I mean, UConn may not be as dominant as the last couple of years, but I
Yeah,
like
they're
I
pretty
like
good.
Bobby Hurley still. So
Well, I'll tell you, if you've learned anything by being a relative strength connoisseur like we have,
mhm.
you have realized that over time, most of the time, your one seeds do really well. VCU is in the tournament. We're going to be rooting for them down here in Richmond, but they're an 11 seed. So chances are
Yeah.
they're probably not going to go too far. But one of my favorite pieces that I put in the report, or that we put in the report each year, is that March Madness piece. And the best part about it is that it has literally nothing to do with investing, right?
Yeah.
On the top level, why don't you kind of run down and we'll throw up the chart that we've updated. But point is that it's got the winning percentages broken down throughout history,
Yeah,
right?
yeah, yeah. So it goes back the last 40 years. The number one seeds have the highest winning percentage at about 80%. Second seeds have a winning percentage of about 70%. Now, if you go all the way to the bottom, 16 seeds have a win percentage of 1.27%.
Right. UVA
Um,
fans, close your ears, right?
15 seeds only win 9.3% of their games. So the general idea is still there. Like the seeding methodology is a pretty good, predictive of the overall in the long run of how teams are going to do. And that's the same thing that we feel about kind of relative strength. And this is a good piece, like a lot of these prospecting pieces that tie back to kind of sports analogies that everybody's aware of are great for talking to clients.
Oh yeah.
So
Well, I mean, the idea is that it's really cool to, sit there and say, I want to have a 15 seed go really far in the tournament, but chances are those guys are not going to make it,
yeah,
right? The same is true within your investment portfolio. It sure is fun to go be a value guy who says nobody's picking this stock, right? I
yeah,
can get it for cheap. Well, there's a reason that they're cheap. There's a reason why they've been so kind of sold down, and we want to avoid those guys. Meanwhile, we want to have the one seeds in our portfolio because historically speaking, they're the ones that lead your bracket to being as close to the top of your little pool that you've got as possible, right?
yeah.
So we like to start up with that, especially with March Madness coming up around the corner. And like you said, Joseph, it's such a powerful tool to be able to prospect and talk to clients about because they understand it.
Yeah.
Relative strength investing can be difficult to understand sometimes, and so
Mhm.
contextualizing it via sports is a good tool.
Yeah, for sure.
What's next, though? I mean, over the last week, I was thinking about topics to talk about today. Last week, David and I had the pleasure of sitting down and talking for a little bit, and we talked about commodities moving to second within the overall rankings, displacing domestic equities for the second position. Now, over the last week, they've moved up into the first position, moving above international equities.
Yeah.
So why don't we kind of talk about that, talk about the movement and what drove it, and how we would react to that change.
Yeah. So, with the moves in crude oil over the last week, I think we said it was about 15% up over the last week. Um, that pretty much shifted almost all the relative strength signals that we have for our commodities energy representatives to buy signals versus everything else, um, which pushed commodities to number one, right?
Right.
Now
Highest
it's
it's been
at
since last summer,
yeah.
right?
And it's
Very
at
briefly.
280 signals. International is at 277, and then domestic equities at 263. That could change pretty quickly,
Right.
right? I would also like to say like cash is at fourth place with 109 signals. So I think generally speaking, I mean, you could pick up some commodities exposure if you wanted to. I will put the disclaimer that I'm not sure if I want to buy commodities after like a price shock like this. It's not like commodities where, gold and precious metals have done really well, but this pretty much this whole move in oil related commodities um, is due to the conflict in Iran. So when any of those things happen and you get like, some of these representatives are like 187% overbought, I'm
Right.
not sure I want to go make allocation changes at that point in time. Maybe let the dust settle a little bit, especially given that like international and domestic equities that have pulled back from like an absolute perspective, like on their trend charts, they generally speaking still look pretty good. Now,
Right.
we'll get into a little bit later some areas that don't look too hot, but overall still a pretty good technical picture for I mean all those three groups, although again, I don't know if I want to buy commodities, especially oil related commodities up here at this point.
Yes, it's important to have, David and I last week were talking about having a system, to kind of contextualize the movement, right? Some advisors like to look at things on a monthly basis. They don't look every single day, right? So these changes have all happened within the month of March. It allows you to kind of get a more normalized picture of the overall rankings. Some will use a signal threshold. So we talked about a 5 or 10 signal threshold of
Mhm.
separation. All it is just understanding that commodities can move really quickly. Commodities are also an area of the markets that are not suitable for every single client, right?
Mhm.
Because they can move around so quickly. So keep that in mind when you are making your changes. And I think the most important thing that you mentioned there, Joseph, was it's not as if domestic equities are now in fifth or in sixth, right?
Mhm.
They're still in the top three. International equities are still in second there. We're still largely risk on. So again, it's not like we're trying to move into commodities and take a more defensive, tone, if you will. So again, just keep that in mind as you're moving things around and kind of looking and looking for ideas, whether that be in precious metals, which continues to have high volatility, or crude, which is going to be very headline driven with all the conflict over in the Middle East.
Mhm.
Anything else on the DALI front that you think is worth mentioning?
Yeah, I think the biggest thing is I'd probably, if I'm gonna make changes, I would probably give it a couple of weeks until at least the end of the month to
Right.
see how the dust settles. And if you're still not comfortable picking up commodities at like the levels they're at right now, just push it to the next month if you really feel like that's necessary. I mean, that's probably what I would do unless crude pulls back like 20% and like, it doesn't give back a bunch of buy signals or something like that, then maybe. But it's so headline driven that I think it's tough to make any major asset allocations at this point,
Yeah.
in terms of picking up commodities or not.
And obviously, keep an eye on those individual relationships, the RS relationships. You can track kind of your own like XLE versus different things,
Hmm.
right? Crude, some DBE versus other things. There's a bunch of different relationships you can track. And if there's any notable ones, we'll obviously throw them in the report as well. Let's shift gears over from the commodities space to the group that commodities moved above, which is, I guess, both of them. But let's shift over into the domestic space first. Now, we have seen, as you mentioned, some of these areas roll over. Growth has picked up a little bit over the last week,
Yeah.
right? But in terms of some of our default charts for our major domestic indices, I think the one that is toughest to defend, in my opinion, is going to be the chart of the Dow, which is now, I think, I'm not looking at it, but rattled off 4 consecutive sell signals, cascading resistance. This really looks like something I don't want to be picking up. I don't know. Help me
Yeah,
say that,
I
right?
would say like if you're optimistic, you're saying there's a lot of support down around 45,600 to 46,000 on the Dow, but it does not look good.
We got the trend break as well,
We got
right?
the trend break as well, which I think that's the big one. That was a pretty good trend line. It didn't necessarily hug that trend line for a long time, but it never got too far away from it. And then it finally kind of like a lot of sideways action to enter the year, and then in March started to break down and enter that negative trend.
I want to
Um,
say I feel like this is my fault. I put together a piece right when it hit 50,000 of like the major milestones. I don't think we even got to the next box on the chart. So
we got to 50,500. So that was the next box.
I messed it up a
But yeah,
little
we
bit.
did, that didn't last very long.
Yeah. But you know, the other areas, you think about the S&P 500, some of the more growth focused areas and the Nasdaq 100, those have all kind of fallen as well, but they maintain their positive trends. They maintain, I don't think they're on buy signals at this point, but they've still got a lot of support down below. the trend break, like you mentioned, is the real kicker here because that's supposed to be our longer term directional helper, if you will,
Mhm.
about which way we're heading, kind of in that intermediate to long term. So, a lot of the Dow, it's obviously um, a
Universe.
smaller universe that you're looking at, and a big part of that universe is financials,
Yeah.
right? Which have struggled particularly. They've fallen in the DALI rankings and things like that. That's your sector, so I'll let you maybe take it away on the financials front. But we've seen a lot of technical deterioration.
Yeah, I mean, a lot of the financials, like they had sort of to fall in the rankings last year in the Dolly rankings, at least after like financials was in the top three for a while, for like
Hmm.
over a year. That was one of the more consistent areas to be in the market. Um, Large cap banks are doing really, really well, right? But if you look at a broad sector representative like XLF, it had essentially entering this year, it hadn't done anything since like August. It
Right,
essentially just stagnated. That's where it started to lose some of its relative strength, right? And that's where it's important to notice, like, yeah, the absolute chart may still look pretty good, and it does for XLF overall, even though it's pulled back quite a bit now. But it didn't go anywhere for 4 months while the market was continuing to push higher.
right,
Um, and that can be kind of be like a first sign, like, oh yeah, this is a weakening type of sector. And we saw that in the relative strength. It dropped out of the top three, and then it's now in seventh place as like the absolute deterioration has really started to set in. Regional banks do not look good.
right,
Um, Payment processors. I use like iPay as a good decent representative occasionally. Um, but even the big credit card names, MasterCard and Visa, those have done well for a really long time. Those really started to kind of weaken earlier this year. But American Express kept chugging higher.
right,
And Trevor made the comment, one of the other analysts, that like that's kind of the K-shaped economy, like American Express, like
right.
the
That's
upper
your
middle
American Black
class, upper
Card, whatever.
class, yeah,
I don't have it, but I
are
just,
yeah, are doing well. They're spending, but middle class, has started to kind of really slow down. Um, but now American Express has really started to falter as well. So we're seeing it kind of across the. If you whether I would look at it as like a consumer spending type of indicator,
right,
like a leading indicator almost, where maybe things aren't as good on that front as we think. And then lastly, like the private markets stuff has just gotten hammered.
right.
Um, Pretty much there's nowhere to hide if you're in one of those private market stock companies. So we'll see how it shakes out. Um, but it doesn't look good for financials, and there's not much to be excited about within the sector either.
Yeah, and it's a bit discouraging because, if you could say, oh, well, utilities are doing bad, right? Like,
Okay.
okay,
Yeah.
oh, whatever, consumer staples is doing bad. Financials are important, right? Financials
Yeah.
are kind of like the lifeblood, especially when you mentioned the first part was regional banks, right? When you think about the lifeblood of some of these smaller communities that are, being essentially, go there for financing and things like
Hmm.
that. But when those areas are doing bad, then on top of that, you're sitting there and saying, okay, well, consumer spending was propping up a lot of this from the kind of macroeconomic stuff. Consumer spending has always been strong. Well, now we're starting to see not only your lower end payment processes, your buy now pay laters, those have sucked for a while,
Yeah.
right? But some of your higher end stuff on the upper end of that K, they're starting to deteriorate as well. You know, it's hard to kind of come up with a particularly
Positive
positive
outlook.
spin on that. Let's put it that way.
Yeah.
Meanwhile, you've got other areas. And to your point on the XLF chart, I think it is important to see that when you're seeing relative underperformance, where do you go? Do you go and you look at the rankings and you say, oh, industrials look good, right? Basic materials are starting to pick up. Technology has rolled over, but still is trying to remain somewhat resilient there. So remember, when you're having exposure to an area and it's starting to fail relatively, then we need to be picking the weeds, right? And going and finding other areas that we can kind of look at.
Yeah,
So,
for sure. And there are still some acceptable places within financials to be, of course. Um, but generally speaking, it's definitely not the risk on environment that we saw last year,
right,
or like second half of last year, because financials were kind of ripping until they stalled around August.
right.
Um, other than the tariff tantrum stuff. But they rebounded really well along with the rest of the market, and had a really good 2024 as well. So we'll see how it shakes out. Definitely something to keep an eye on. If you do have exposure, be picking the weeds pretty
Yep.
closely at this point. It's not one of those sectors where you want to give it a long leash at this point.
Right. Especially, and if you do have names like private credit, right? Those names are already very oversold. We're looking for bounces to get out of those,
Yeah.
right? So just keep that in mind. You're in different, you know, you're in different parts of the cycle, or your buying and selling process, depending on what the name looks like. If you're, up, keep a very tight leash on it. If you're down, and you're oversold, we're looking for bounces to move out. Okay, anything else on financials before we wrap up?
I don't think so.
Okay. Well, the last part we hit on commodities, we hit on domestic equities, we hit on some sector stuff. Let's talk about internationals, which have felt like they've kind of gotten forgotten about as
Yeah.
commodities have stormed up and domestic equities, you've seen some volatility. International equities remain relatively strong on
Mhm.
on the global stage. The dollar has picked up a little bit, returned to a buy signal, which isn't the point of today's conversation.
Yeah.
But in general, international equities, second place within DALI, above 4 on the asset class group scores page in terms of their overall score. On a more simple basis, what we did as a kind of a general study was we took a rolling 6-month performance spread between ACWX and SPX, and we sent that all the way back to 1988, which we'll throw up on the screen right now. Over the last 6 months or so, we've seen that spread run to about 7%. It's cooled off a little bit. The main point about this here is the overall percentage of days in each decade that we've seen that spread be positive, right? If that spread is positive, that means ACWX has done better over the last 6 months. So far in 2020, in the 2020s, we've seen that up around 27%. Compare that to the 2010s, we saw ACWX only better than the S&P for about 16% of the overall time. So again, shorter decade's not done, but we have seen a material shift in how well international equities are doing just on a pure performance basis. Compare that to pre-20 or 2000, that was around 27% as well. And of course, the lost decade for domestic equities, international equities were doing better in about 68% of the
Yeah,
time.
that was a really good time to be able to have international as well as small cap.
Right.
Was that especially like mid 2000s, that right in that sweet spot from like '03 to essentially early '07.
Right.
Um, Pretty good spot to be. Uh, yeah, it's interesting. I think a lot of our asset allocation systems and models have either picked up international equities over the last year in terms of like what the base allocation is. They picked up a little bit more than they've had,
Right.
or have like essentially maxed it out,
Hmm.
um, which has worked out pretty well. I mean, most of those changes kind of started happening right around April, May last year,
Right.
and they've continued to do really well. Whether you're in emerging markets or developed markets for international, I still kind of prefer developed markets, even though they may not be as sexy. They're a bit more consistent, which I like, and um, that's also pretty good for any like momentum strategies in
Right.
an environment where there's some stability,
And
right?
consistency.
And
Right. Yeah.
consistency, yeah, exactly. Um, but we could be heading for another decade where international does really, really well. Keep an eye on the dollar. That's just another good barometer to watch out, um, or look at for kind of how are capital flows going. I mean, that's the reason why the dollar's down. It means people are selling dollars, buying other currencies to
Right.
invest locally, essentially. Um, so keep an eye on that. It did move back to a buy signal, but it's still kind of firmly in a negative trend. And it's been very choppy over the last couple of months. Yet internationals continue to do really well over
Right.
that period. So it's not necessarily the dollar has to be falling a ton. It obviously helps international. Um, but the overall technical picture still looks really good. And make sure portfolios are starting to adjust to that too.
Yes, and here's the thing. We talk with clients all day, and I think the most important part to remember on this, and then we can wrap up, or I'll give you last word, and then we can wrap up. Um, you know, what we've seen in such a S&P 500 dominated last decade or so, people are saying, "Oh, is it bad that that isn't the only thing that's working?" I think as trend followers, it actually, and money managers in general, when your benchmark is the strongest thing, you get punished for leaving the benchmark at
Yeah.
any point, right? So if we're seeing other things starting to at least compete with a still strong benchmark, but there's some other stuff that you can rotate into, that's great because we can go out and actually pick and choose things that look relatively strong. Internationals are one of them, right?
Yeah.
So it's not necessarily a bad thing of, oh, domestic equities is rolling over. That just gives us an opportunity to go out and find those relatively strong areas in the
Mhm.
market if we can do it properly. I think is the kind of the caveat there.
Yeah, yeah. And that's been that's been the general thing is like, well, how can we outperform the S&P 500 without essentially being more concentrated in the
Just
benchmark or like using
leverage.
leverage? Yeah. Um, just because it's been so good. Like, I
Yeah.
mean, it's really hard to beat an index that's 40% in a handful of stocks, and those handful of stocks are just doing incredibly well relative to everything else.
Right.
We've seen that flip a little bit this year. And then with international kind of emerging, it's nice to have another area to go.
Yes.
Um, but yeah,
All right. Well, Joseph, it's great as always, and I hope you enjoyed. I certainly had fun today. Keep in store for next week's movement. Enjoy the beginning of March Madness, and we will see you next week.